Good day, ladies and gentlemen, and another warm welcome to another technical summary video presented by me, Letty Janse van Vuren. Our topic for today is a practice directive, or as we call it, a practice note, that was issued on interest earned on trust accounts, and it was issued by the Property Practitioners Regulatory Authority, the PPRA. So let's just go and have a look at what this caused so much confusion when it came out. So let's just see if I can put this into perspective for you and give you some clarity. I'm going to start off with why this is important, looking at a quick introduction, going through an overview and contents of the publication, and then just highlighting a couple of important aspects as it stands now. And then I'll take you through links that take you to the source and bonus documents. All right. So we look at the picture in images here, or the story in pictures. We are definitely in the realm of trust accounts and, estate agents or property practitioners trust accounts, as luck would have it, and issued by the PPRA, and it's all about the interest that is earned on that trust account. Right. So that's the realm that we are operating in. The abbreviations that we are using today is the PPRA, which I just told you what it stands for. PP is Property Practitioner, PPA Property Practitioners Act, PPFF Property Practitioners Fidelity Fund, and then TA is Trust Account. Right. So let's look at why this is important. We know that the Property Practitioners Act is something that your clients who are property practitioners have got to comply with. It's a legislation, so they must comply with it. If they don't, then we have non-compliance with laws and regulations. That then makes it so that your no-CLAR reporting responsibilities kick in terms of our code of conduct. We then have certain reporting obligations. Now, depending on the severity of it, we would either then report to management, qualify our audit opinion, or then simply report a reportable irregularity, an RI, whether it is to IRBA for companies or for independent reviews. We would then report to Sub-C. But we also need to make sure that if you have clients that operate in the property practitioner's realm, that you keep up to date and you are aware of guidance that is published by the PPRA, and this one specifically to ensure that the interest earned on trust accounts is correctly paid to the Property Practitioners Fidelity Fund. So yes, we know that a PP must comply with the PPA, right, as well as notices that are issued by the PPRA, and they also need to be aware of the latest changes, right? Now, I know 9 out of the 10 times they all rely on you as the practitioner to inform your clients, to tell them, listen, this is now what's new. But because they just, they go about their business and they're not too phased about the compliance of it. As part of an introduction, let's just look at what the current situation is per the Property Practitioners Act. When the Property Practitioners Act came out and it replaced the Estate Agents Act, the Estate Agents Act literally said initially that the interest is done on a 50-50 split. Then the Property Practitioners Act came out and it said the same way that the interest is now payable to the Legal Practitioners Fidelity Fund, 100%, the same way with the Property Practitioners Act is that if you do have any trust accounts, right, now that would be all your trust bank accounts, your section 54(1)(a) accounts, and then you've also got section 54(2) accounts, which are some of the savings trust accounts. So if it's mandated that you would then you can access that, or the interest, or if the interest would then accrue to the trust creditor. So depending on what the mandate says and what the lease agreement says, if it's properties that are leased or owned, yes. But in essence, the trust account interest is paid over to the PPRA and to the PPFF to enable efficient administration, specifically of the audit compliance process. That's why they get paid the interest. Right. In terms of the legal practitioners, similar, but also for when they get sued. Right. So that's why they have payments that are made to the Fidelity funds. That's what the Fidelity Fund is all about. So in terms of the trust bank accounts here, the auditor, in terms of the Property Practitioners Act, needs to declare 100%. All of the interest earned on the trust accounts need to be declared, and it will then, they will fill it in the document, And the property practitioner's fidelity fund will then invoice the property practitioner within 30 days after receiving the trust audit report. Now, we know the trust audit report is effective when, or is due by the end of August. So by end of September, they will receive an invoice. And the property practitioner then has another 30 days after they've received the invoice to settle it. That has not changed. This process remains. It is just that in the past, the Fidelity Fund has invoiced 100%, and in terms of the new Practice Directive, they are only going to invoice 50%. So that was the way that it worked in the old days, 100% of the interest payable. Now, the PPRA issued this Practice Directive, and they call it, strangely enough, Practice Directive of 2023 on interest earned. And this now directly contradicts the Property Practitioners Act, because now they say there's a 50-50 split on interest earned. So let's go and have a look, because that's where the niggly comes in. And people, I got lots of panicky calls from auditors with estate agents as clients, and they said, well, what do they do now? Do they now have the 100%, and do they wait? And I told them, if you've already submitted it, then the 100% is fine. The Fidelity Fund will only invoice you the 50%. They'll invoice the property practitioner the 50%. But if you have not yet submitted it, make sure that you now do this correctly, because the auditor needs to do this in their agreed upon procedures, right? And doing so on the letter that they issue that's available on the URBA website as well on this. So yes, and this Practice Directive applies to all property practitioners who are keeping and maintaining trust accounts in terms of Section 54. And Section 54 being your trust and your savings bank accounts. Okay, Section 54 1A, and then your Section 54.2, which is your savings account. So the publication looks like this. It still baffles me why they say 2023, but in any event, I have no idea why. I think it was for the 2023-2024 year. Well, however they do that is fine, but it is effective from the 16th of August. It was issued by the PPRA on the 16th of August, and the purpose of this Practice Directive is, number one, to provide guidelines on how to administer the trust accounts by property practitioners. It also sets out practical measures for handling and treating the trust monies by property practitioners. And also, it then provides guidelines on the payment of the interest earned. Right. So that's in a nutshell what they said. So let's go see. I mean, it's not a long document. It's 8 pages. So let's go and summarize. Here's the contents of it. So they start off with the purpose, then how this is applicable. The purpose I've already just given you now on the slide. Applicable, we know that this applies to all property practitioners who have trust accounts. Then what the problem is, and here they are talking about the controls and everything, how to administer trust accounts, the responsibilities of PPs to safeguard the trust monies, the declaration of interest from trust accounts, the payments of interest, and then what the consequences of non-payment is, and then obviously a conclusion. So let's go and have a look. That's in a nutshell the contents. What are some of the most important aspects? And here's my summary of the 8 pages. So even though it contradicts the Property Practitioner Act, the Practice Directive controversially now splits this 50-50. 50% accrues to the PPRA, and that must then be paid to the PPFF. The other 50% accrues to the property practitioners. So what must property practitioners do? They must submit their audit report 6 months after the end of their financial year. Well, not them, because their auditors should be doing this on their behalf, but they need to liaise with them, all right? They need to liaise with the auditors to make sure that this is done. Once the audit report is done, they must then also declare the interest earned from the trust accounts, because there's the declaration form that needs to be filled in, and then they'll pay over the 50% that accrues to the PPRA, to the PPFF. All right. And I said here the PPFF will still invoice them within 30 days after receiving the auditor report. But if they receive the auditor report and the interest form that still shows the 100%, they will only be invoicing 50% from their side. So they will still only invoice 50%, and you will then go and settle that as the property practitioner, right, within another 30 days. If you don't comply with this Practice Directive, It is non-compliance because compliance is what? Mandatory, which means thou shalt comply. Right, so going forward, this is what we're going to do. So when everybody was panicking to say, oh, well, it used to be 100 and now it's 50-50, so am I declaring 100% or am I declaring the 50%? You will declare the 100%, okay? Because only the 50% will be payable by you as the property practitioner. So your auditor will then declare the 100% and then say, okay, 50% is payable to the PPRA by the PPFF. They will issue an invoice to the value of 50%, and the other 50% the property practitioner can then keep. So I hope this gives you a little bit of an idea of what the impact is of this. Right. So the major changes, it just goes from 100% down to the 50-50. The source document that you've got here, there's the actual practice note. You can click there and you can download it. And then just for the hell of it, there's the guidelines, the latest ones that were issued in 2023. I think it was March or April somewhere in 2023. The PPRA issued these guidelines on audit, accounting records, and trust accounts. And in this one, they stipulate still the 100%, but the practice note will only change. The only thing that's changed is the 50% that is now payable. All right. So yeah, there are your links to your source and bonus documents, and you can simply click on them to download. Any questions or you feel you still need more detail, please refer to my Knowledge is Power slide. Remember that we publish the technical alerts on a daily basis. I do the content of the technical daily alert, and that then gets posted by SAAA on LinkedIn. You can go and follow them, and also available on the news section on the SAAA website. You can also then access SAAA's YouTube channel for webinars and other TSVs that I've done. The other technical summary videos, there's about 190 of them, and you'll find all the TSVs on the SAAA YouTube channel as well. The webinars on demand is where you've maybe missed a topic. I know we have had specific webinars relating to property practitioners in the past. I remember when the Property Practitioners Act came out in the beginning, I still did one of the webinars on that when it came out initially. So everything is available. You can go and access it and then listen to the recordings at your leisure. Then we've got the MCLU subscription, which is on a monthly basis. You can then gain access to a 2-hour power session where we tell you about everything that's changed in the last month. Right, so we take the mess and the fuss out of reading through millions of emails by me reading the millions of emails on your behalf and then summarizing that into a 2-hour session. Right, so that's the MCLU subscription. But that then, ladies and gentlemen, is it on the brand new practice directive that was issued by the PPRA on interest earned on the trust accounts for property practitioners. I trust that you enjoyed this with me, and I wish you a blessed day. From me, Letty Janse van Vuren, thank you and goodbye.